In today's video, we're going to talk about how you can get started in investing, specifically stock market investing. And regardless of what your financial background and income is, anyone can get started. This video is going to be comprehensive and detailed, so I'm going to post timestamps to the left here and in the description below, so you can skip through the parts that you find interesting, or you can troop through this entire video. We will be touching on some technical definitions, but I promised you guys that I will try and go in as layman terms as possible and explain things as easy and as comprehensible as possible, so this touches the broadest audience. Also guys, if you find this video helpful and if you like the contents of my channel, please consider subscribing. So why start investing? Do you want to retire early? Do you want extra income? Do you want to be financially free? Or do you want to break generations of low income and set up future generations for wealth? Any of these are valid reasons to start investing. So what is investing? We'll start off with the technical definition first, and I'll break it down to it in plain English. Investing is putting money to work for a period of time in a project or service in hopes of generating positive returns. It's the act of allocating a resource, usually money, with the expectation of generating an income, profit, or gains. So in other words, investing is taking your time and effort and resources and putting it into a product or service that you think will grow over time. And with that growth, also profiting from that product or service. So a very common type of investing is purchasing a house. Let's say you purchase a house for $100,000, you let it grow for years, and the property value of the house goes to $150,000. That difference between $150,000 and what your initial investment was is $50,000, and that is the gain on investment that you make. Now, there's a lot of barriers to entries when it comes to purchasing a property, especially if you're in your early 20s and you're still a teenager. Houses are expensive, and it's not a viable option for everybody. But in today's video, we're going to be focusing on stock market investing, where pretty much anybody can get started and start investing in. So the next question is, why start investing? Now, you're probably thinking, I have a great job, I do my budgeting, I don't spend a lot of money, and I save a lot of money in my bank account. Well, if you've been paying attention to the news for the last 12 months, there's a term that's been floating around, and it's called inflation. So what is inflation? Well, inflation is quite literally the inflation or the expansion of the price of our product or service. I'll give you a great example. 2 years ago, the price of gas here in Canada was about $1 per liter. This year, a few months ago, that price jumped to almost $2 a liter. Now that price of gas has inflated, and the dollar value of what $1 can purchase has now gone down, meaning the value of your dollar has gone down and it's not worth as much as it was 2 years ago. Now, inflation is usually around 0.5 to 2% per year, but this year, inflation has jumped as much as 10%. So that means you have to earn 10% more money than you did last year just to be able to afford the same goods and services. That is absolutely wild. Now, a bank savings account typically provides an interest of 0.05%. Think about the number, 0.05%. That means when you put your money in your bank account, you're actually losing 9.95% to inflation. This is where investing comes in. Investing can not only help offset inflation, but if done correctly, you can also let that investment make you a profit. Now, when you're purchasing a share or stock, your end goal is to have that share or stock grow and have a percent increase. And that percent increase is what you profit. But if you let that share or stock sit long enough and let it grow, it'll start growing exponentially as a result of compounding interest. I made an entire video on compounding interest. I'll put it right here. It's actually one of my very first videos on YouTube, but it's a very good metric to understand, and it's a great strategy. The longer you let an investment sit, the more it will grow and the more it will compound over time. If you're not convinced on investing yet, I'm going to provide you with an example. In 2010, had you invested $10,000 in Apple shares, that $10,000 would be worth $184,000 in 2022. And that's all without you having to lift a single finger. Now, let me give you the flip side to that. Had you put that $10,000 in a low interest savings account in a bank account, that $10,000 would be worth $8,000 today in 2022. So you actually lost $2,000 worth of value by letting your money sit in a bank account. The difference between $184,000 and $8,000 is pretty substantial. Okay, so you've heard me talk about stocks and shares, but what exactly is a stock or share? Essentially, it's an equity or a share or a piece of a corporation that you own. In layman's terms, it's essentially an IOU provided by a company, and it's given to you as a result of you putting your money into that company. So for example, if I purchase a $100 share in Apple, that $100 is a IOU to you from Apple. Now, that IOU or stock or share price will fluctuate based on what the stock market dictates. That price might go up, price might go down. But whatever the market dictates is what the company will owe you once you decide to sell that share. Now, owning a stock or share is more than just investing and hoping for a financial gain. Owning an equity or a piece of a corporation also allows you other rights, such as voting when board of directors are elected every year, and you have an impact on the future of the company. Now, the larger a stakeholder and larger of shareholder you are, the more shares in a company you have, the more significance your vote and your say is. That's what stocks and shares are, and that's essentially what a shareholder does in a company. The other benefit of owning a stock or share in a company is being eligible for dividends. A dividend is a profit that is paid out from the company to its shareholders as a result of their earnings every year. So dividends are typically paid out every quarter. This is a very standard procedure in Canadian and pretty much all universal corporations that are traded on the stock market. And that dividend essentially is a cash payment to every shareholder. The more shares you own in the company, the more dividend payouts you get. Now, there's a quick caveat to this. Not every company pays out dividends. A lot of companies will take the profits that they earn and reinvest those profits into the company. These are typically called growth shares and growth stocks, but it's a very good advantage of owning a share or stock. Now, dividends can be calculated based on the dividend yield. The dividend yield of a company is the percentage of the dividend relative to its stock price. The higher the dividend yield or the percentage, it means more the dividend payout is relative to the stock price of a company. So for example, if a company has a dividend yield of 5% and the stock is worth $10, that means a company will pay out 50 cents in dividends per year. Now, this varies across all companies and corporations because their earnings are different and profits are different. So dividends are not equal among companies, and dividend yields should be looked at through a microscope and looked at relative to the company share price, not relative to other share prices, if you know what I mean. Okay, now that you know what a stock and share is, how do you go about in purchasing these? Well, back in the day, it would be a comprehensive process of getting a hold of a stockbroker, calling them up, and filling out an order and requesting the broker to purchase a share. Nowadays, everything is streamlined and done through online brokerages with a click of a button. Everything is streamlined, and the fees are a portion of what they used to be back in the 90s and the early 2000s. Every country around the world has different trading regulation and laws, and every country has different online brokerages. The most common one in the United States is TD Ameritrade and Robinhood, where here in Canada, the most common ones are either TD, RBC, Questrade, and Wealthsimple. I personally use Questrade, and I have an entire video tutorial on how to use Questrade. As a matter of fact, there's also a sign-up link in the description below where you can save on a few of your early purchases and save on some of the exchange fees. Okay, so once you've figured out what online brokerage you want and you've signed up, the next step is to create an account. And there are various types of accounts you can choose from, but my recommendation is to pick one that is a tax-sheltered account. Now, what a tax-sheltered account does is when you make a profit or gain from selling an investment, you will not be taxed, meaning it's not a taxable income that you have to pay back to the government. In the United States, a very common tax-sheltered account is a Roth IRA or the 401k, where in Canada, we have something called a TFSA, which is a tax-free saving account. I actually have an entire video on tax-free saving account you can check out, but this makes sure that all the money that you earn from your investments, you keep, and you don't owe the government a single cent. Okay, so everything is set up. You have an account, you have an online brokerage. What stocks do you purchase? And I'm going to start this by saying I am not a financial advisor. This video is for entertainment purposes only. I'm not liable for any losses you incur. Now that that's out of the way, I would advise you to take everything and every information given to you, especially on YouTube, with a grain of salt when it comes to stock recommendations. My personal philosophy is I like to look at the financials of a company. I like to understand how they operate, whether they make a profit year in and year out, and whether or not they have products or services that are actually used by consumers, and do these companies push out and innovate for the future. That's why I stick to companies like Microsoft and Apple, where they have a very large consumer base and they have a product like the iPhone or the MacBook that is used en masse by everybody. They have an actual physical product, they turn a profit from the products, and as a result, their share price reflects that. So when you're looking to purchase a stock or share, the best thing to do is do as much research on yourself individually, and then perhaps as a secondary outlet, go and do some research and listen to some videos on YouTube, like people like me, on what they recommend. But at the end of the day, it's all determined on what you think is going to be profitable and what your research indicates to you. And guys, by research, I mean actually looking at financial reports, not just the historical prices of these shares or companies. It's very easy to look at a trend chart and look at historical charts and say, oh my God, over a year, the price of the share is going up. That means it's going to continue to go up. No, that is incorrect. Historical performance is no indications of future prices. Might give you a pattern, but nothing is set in stone. So do your due diligence, go to the company's website, download the reports, look at the product lineup, look at the profits that these companies are making, and then base your decisions on that. Now, if you find that the research and the time that you're putting into these individual shares and equities is a bit too cumbersome, there is an alternative. It's called exchange traded funds. An exchange traded fund is essentially a fund like a share and equity that tracks an entire index. Now, an index is a portion of the financial market. It's a hypothetical portfolio that has a collection of companies in it. For example, the Dow Jones, the Nasdaq, and the S&P 500 are all indexes. And these indexes are comprised of various companies. Now, with an exchange traded fund, you essentially just purchase the entire index rather than having to worry about a specific stock. One of the great advantages of purchasing an ETF or an exchange traded fund is that you hedge against a lot of losses. So the growth might be slower, but the losses that you might incur are much less significant than that would have been from an equity or a share that plummets. Now, I have an entire video on index funds that you can check out right here if you want a better idea. So here's an example of an ETF. It's called the VUN Vanguard Market ETF. And as you can see, it has a bunch of different holdings within a single share. You have Apple, Microsoft, Alphabet, which is Google and Amazon, and you have different sectors as well, such as technology, healthcare, and consumers. This diversifies your share and you're less prone to market plunges. And it's a good way of investing in a bunch of different companies all through a single share, which is hassle-free. Another question that you might have is, should I be doing something else before I start investing? And the answer to that is yes, you should be. The first thing is making sure that you pay off all high interest credit card debt. Credit card debt can have interest rates as high as 25 to 30% per year. This is 30% that's going down the drain and it's going just for interest, which could have been used for your investments. Making sure you get rid of this debt is not only freeing for the mind, but also make sure you're not losing money and throwing away money at just interest rate payments. Now, the second thing I would recommend that you do before you start investing is having an emergency fund. An emergency fund ensures that you have a backup plan if, for example, you lose your job or a family emergency occurs. Having a 3 to 6 month emergency fund that will cover both food, rent, and other expenses is usually recommended before you start investing. But once you've covered those two things, you should start investing right away. Usually, and for most countries around the world, the minimum age to start investing is 18 years old. This is the minimum age required to open up most direct investment accounts. But once you turn that age, you should start investing immediately. Next question you might have is, how much money do I need to start investing? And the answer is you can go as little as $100 if you want. Invest only as much as you can afford to lose. I look at this as almost a sunk cost. The amount of money I put into investments, it's money that I won't be touching for a very long time. Remember, there's always some amount of risk involved with investing. Investing doesn't always guarantee a return. Markets fluctuate and you might actually end up losing money. So be very cautious with the amount of money you put into investing and don't get greedy. But there is no minimum threshold when you start investing. So best bet is whether you have $10, $100, or $1,000, whatever you can afford and whatever you're comfortable with putting in towards investments, that's what you should start off with. Now, here are some mistakes you should avoid when you start out investing. Number one, panic selling. Yes, it can be tough looking at your stock and not performing well, but the last thing to do is panic sell. Remember, you don't lose money until you officially sell. The best bet is to stay focused, stay disciplined, and let the stock ride out any fluctuations. Remember, in any given day, there are thousands of market fluctuations and a share price will go up and down multiple times. Just be disciplined. Number two is buying hype stocks because some guy on YouTube or your friends recommended it. Remember, if a company is too good to be true, then it probably is. Always do your due diligence and always remember to do your research when purchasing a stock. There are a lot of stocks that are called pump and dumps, where they build hype around a stock, people invest, and then the few investors that initially started with this Ponzi scheme sell everything, and then everything goes to zero. Do not fall for this at any cost, whether it's cryptocurrency or stocks and shares. Do not fall for hype stocks. And number 3 is not sticking to an investment strategy. Remember, like all things in life, discipline and strategy are the 2 key components for success. Always have a set amount that you are willing to invest every month. Stick to that amount and stick to a select few shares. Diversify your portfolio in a way where you can hedge against losses, but always stick to a strategy no matter what. Just like panic selling, there's also panic buying. You see a share doing well, you're like, wait a minute, I want to get on this ride, I don't want to miss out on it. Do not fall for that trap. Be disciplined and be strategic, and you'll be fine. Well guys, I hope you enjoyed this video, and I wish you the best of luck in your investments. And until next time, peace.